Hi, everybody. This is the Physics of Bitcoin show. Um, Today is August 27, 2025. I am here with Stephen Perrenaud, it is my fellow physicist, and this, you know, you uh, you had an intuition from the title that is about physics, right? So basically, we always summarize a little bit what is the show about. What is the show about? So we are trying to use physics principles because both of us are physicists. We had a kind of an interesting career where we change fields. And today I actually was listening to something very cool. It was Peter Diamandis. There was the ex Google CEO. There was some other AI expert, and we were talking about one of the biggest challenges of AI in the future will be to train the AI to apply ideas from one field to another field. Because they say that actually some of the greatest breakthrough in humanity were exactly like that, when we took something that we discovered in a field and then we applied it to another. And I was smiling about that because that is exactly the theme of this show, where we use concept from physics and we apply to to the field of Bitcoin to understand Bitcoin. Um, and that the power law is our guiding principle, is our main idea behind these studies, but it's not unique. We also do other things that are also physics like, or we are motivated by things that we discover in trying to understand the physical world, and we also apply to Bitcoin. And like we mentioned in the past, it's kind of interesting, but also a little bit challenging because we're trying to come up with new results. So instead of simply looking at the market, say, oh, this is what the price is doing, we're really trying to make new discoveries. This show is about bringing new result, a new insight. They don't have to be breakthroughs every single time. So, many times science moves one step at a time, one small little step. But we are adding, if you're looking at all our show, and today actually is what, number 30, right? We every single show, I think maybe one time we review a paper, but even there we still present some new results. We presented a new idea or new discovery that you have actually um, the privilege, if you want, the same thing with us, of seeing it for the first time. Nobody else saw these things about Bitcoin in the past, right? So it's a pretty amazing thing. I know that I'm pushing, pushing ourselves a lot here, but it's the truth. This is what happens, and it's not just me, but even Steven. Steven is a driving force of this show, and it's pretty amazing work that is done. Anyway, so Steven, you want to add anything to this?
Yes. First of all, welcome everybody to show number 30, Physics of Bitcoin. And I was having a discussion yesterday with a friend. Actually, he's an Italian guy who lives here in Thailand. And we were talking about emergent behavior in physics. And really, Bitcoin is an example of emergent behavior in physics. So there's a big debate around gravity about whether gravity itself is an emergent field or property or force. And Bitcoin being about networks is about the emergent behavior that networks can have, communication networks and social networks. And that's going to be a large part of the content today. So with that, I will transition to the slides.
Great.
And let's go full screen. So that's a picture of Robert Metcalfe. He is the one who, not only was a co-inventor of Ethernet technology, and he's still with us. He's getting on, but he's still with us. But he's the one that proposed Metcalfe's law, so it's named for him. He proposed it, and it's the idea that as these communication networks scale, that their value grows faster than their scaling, faster than linear, and something like the square of the number of users or telephones or internet connections on the network. So we're going to talk about institutional holdings of Bitcoin today, and we're going to talk about it with respect to Metcalfe's law. So institutions can be considered as network fat nodes, and we've seen a steep growth in the institutional holdings. I will show you that it's been on a power law trajectory in recent years. We'll have a kind of related question: why is there little to no holdings by the very largest companies, Amazon, Microsoft? They hold 0 Bitcoin. Why? The next one is the question, as physicists, we like to ask why. So the question is, why are we observing with Bitcoin a power law with an index of about 3, maybe a little bit above 3 for the adoption? The number of addresses with time is one measure of adoption, but adoption is more complicated than that as well. So we'll discuss that also. So that's going to be the main content, but then I've got 2 other items. One is a quick revisit of the Hurst exponent. Turns out you can validate the high Hurst exponent in 5 to 10 minutes using GPT-5. So I'll show you how I did that. And then we'll talk about the latest results of log periodic power law modeling of Bitcoin's rise and bubbles, or at least the waves that we're seeing in price movement. And we're going to look at different time scales. And the picture's a little bit murky, but we'll step through that and see what it looks like it's telling us in terms of, how long we're going to go until a crash, that kind of a thing. Okay, so the first is the premise of fat nodes that result in power law tails. So more and more of the Bitcoin net acquisition is with ETFs and BTC treasury companies. So if somebody invests in an ETF or purchases shares in Strategy or another treasury company, or even, for a long time now, custody at an exchange, they are attaching to a fat node in the network. And fat nodes in a network support power law behavior with respect to the distribution of the resource. And this is true for airline hubs and for Google and for Bitcoin exchanges and ETFs. So it's a form of preferential attachment. People preferentially choose to fly through an airline hub or to, purchase on a large exchange. So there's a favoritism mechanism for the larger exchanges and the larger ETFs. And then certainly with respect to the network as a whole, people are preferentially attaching to them as an alternative, or maybe in conjunction with their own, cold wallet. And what's often found is that you get Pareto-style distributions with power law tails of index around 2 to 3. That's kind of typical with this fat node behavior in a network. And I just asked the question about what studies of the Bitcoin graph have shown. So the search results in attachment and connections indices of around 2 to 2.5. So that is, and I'll show you the form of the plot, I think, on the next chart. So that's the number of connections in the network and how many connections you have to a fat node. So the number of connections kind of scales as a power law of index 2 or steeper, where fat nodes have many more connections than skinny nodes. Holdings are a different thing. They're not the same as connections, but the holdings tend to fall off relatively steeply as well, roughly like this square, but it's a bit more complex, and I'll show you that. Okay, so this is the holdings for the treasury companies, and the chart on the left shows the top 100, and you can just provide that image to ChatGPT, and it will generate the chart for you. So this is the BTC held versus the rank in this chart. So that's a Pareto style chart. And so what's being plotted in the graph is the log of the BTC held, so holdings on log scale, and also the rank on log scale, where the rank goes from 1 to 100. And what we see is a single power law doesn't fit very well, but you can fit it pretty well with 2 power laws and a break at scale around rank 15. And actually, this one excludes master, because master is kind of off the charts there. You know, it's 2/3 of the way up to 10 to the 6, right? Because they're well over 600,000 now, with 3%, I guess, of all Bitcoin. And if you take the rest, though, that first segment falls off basically as the inverse power. So it's a power law of -1, and that's a Zipf's law kind of behavior. But then beyond that, it gets much steeper. It's more like -2.5, 2.4 for the bulk. Now, this is a very dynamic situation. It's quite new. It's evolving rapidly. People are, companies are rushing into this kind of behavior, and they have relatively small amounts, of 100, 200, 500 for the lower half of the list. What we would expect here is that, not all of these are going to be incredibly successful, right? Because they're all scrambling for a limited supply. And so I suspect what we're going to see is that some of them will be successful, some of them will fall out further in the tail, and we'll see this red line kind of extend further out. And we'll get some flattening of the overall distribution. But we'll have to see how that evolves. This tabulates the growth of institutional holdings since the end of 2017. These are annual snapshots. And there are 3 columns: corporate BTC, fund trust BTC, and the ETF BTC. And the corporate includes exchanges, both public and private companies. It includes Bitcoin miners that are public. And then the ETFs, if they held any for their own account, would go in corporate. Then we have the funds, which was mainly grayscale, and that converted to ETFs. So that's the next column. And so now we're in a situation where there's about 1.9 million in corporate Bitcoin, and there's about 1.5 million in ETF Bitcoin, for total institutional having grown by a factor of 10 since the beginning of 2018, from 300,000 to 3.3 million. So you can run regressions on these on various things. And if you run just the holdings of Bitcoin as a function of time, and time 0 is set to January 2009, so it's the age of Bitcoin, just as we do for everything else, you find that Bitcoin has been increasing at the 4th power of the age. That is, the Bitcoin institutional holdings are growing is about the 4, maybe 4.5 power of age. I tested how sensitive it is by excluding the first data point, which was also kind of discordant in price terms because it was at a peak. And so we see about 4 to 4.4. The holdings versus the price is about a 0.7 power law. The R squared for the growth in holdings with time is very good. It's 0.94. So this shows a graph of that. Again, it's a log chart. It's holdings versus age. And the age, starts at age 10 years in this case, and then goes up to about 16. And so it includes ETFs, exchanges, public and private companies, miners. R squared 0.95 for this particular one that had the first data point removed, and that got an exponent of 4.5 or 4.46. And without removing that first point is 4.0. So it's roughly in that range. And this shows how the institutional holdings have grown with price. It's about a 0.7 power law. The R squared's not quite as good as 0.83. You can see the highly discordant point, which is the one that has at the lower bottom in the center, 4.2 almost for the price. That was a peak in 2017. So is not that much Bitcoin were held relative to the price for that point. But it didn't make too much difference. We're in this 0.65 to 0.7 range. Okay. Now, this can't go on forever because there's obviously a hard cap, sitting up there above log 10 of 6 and 7. But for now, it looks like it can go on for a few years. And just for context, for the current year to date, 70% of the net buying has been by public companies, including Bitcoin treasury companies and others. About 22% by ETFs, about 8% by governments. Private companies have been flat, maybe slightly negative because of Mt. Gox outflows. And retail has been selling on net. And we've seen examples of some large whales selling small portions of their overall holdings. And there's basically providing supply to the institutions at much higher prices than where they bought. And other retail has been selling too on net. So BTC held versus price says that adoption, buying quantity is increasing as 0.7 power of price. The retail quantity is decreasing, so there's ownership diffusion. And the reason why I say that is because it's not these institutions that own it for their own accounts. They own it as custodians. They're custodians in the case of ETFs, and they are custodians for their shareholders in the case of public companies. And where the public company's shares are held by Fidelity or some big broker, they are in turn custodians for many, many, retail accounts. So at the end of the day, these are custodians. One could even argue the government holdings that they're custodians for their citizens. So the number of beneficiary holders is increasing. There's ownership diffusion. And we've talked about this in prior shows when we looked at sort of trying to correct for the Pareto relationship of wallets in general by looking at the custodian ownership and how many users they represent. Market cap goes as price, basically, and they are proportional to price. So the inference is that price is running something like the inverse of 0.7, like institutional adoption to the 1.4. So to the extent that institutions are dominating net purchases and driving the price, it would be a relationship something like that. And that's consistent because I just showed you that institutional holdings are rising as the fourth power of time, fourth power of Bitcoin age. You multiply that by 1.4, you get 5.6. And that's consistent with the overall power law index that is about 5.7 to 5.8. This one has an R squared of 0.83. Okay, the holdings by the Magnificent Seven are almost zero. As far as we know, the only holder is Tesla, and what they have is small. They have 12,000 Bitcoin. That's a little over $1 billion worth. SpaceX has some. You combine that, it's about 20,000. So it's a little over 2 billion if you make it a Musk kind of thing. So the question is, why haven't they bought? And I would maintain that institutions will adopt if and only if, that's what this IFF means, if and only if the price is high. They need large capital store, and this is why they're late to the party. The price is just too low for them. It's not sufficient for them to be able to go out and buy in quantity, because if they want to buy for their treasury, they want to be part of their operation. So they want to be able to buy and sell, and they don't want to disrupt the market with their own operations. If you took one of these typical companies that has of order a couple trillion market cap, they're in this sort of 2 to 3. NVIDIA's NVIDIA's over 3 and Tesla's under 1, but they're in that sort of 2 trillion average. 1% of that is 20 billion. their cash holdings range between 27 billion and 110 billion for the top 6, and the annual cash flows are 50 to 120 billion. So if they put 10% of their cash holdings into Bitcoin, it would be 3 to 11 billion, and for the top 6, that would aggregate to 42 billion, or 360,000 Bitcoin at current prices. And if they did that all within 1 year, if they did it rapidly, it would be about a 100 billion market cap increase. Though not enormous, about 5% of the current market cap, if we assume a sort of typical market multiple. Although if all of these entered, I think it would have an upward effect on the market multiple if they did it rapidly. But the problem that they're facing is that Bitcoin is rising much faster in value than their cash balances are. But their cash balances are growing very healthily because they're all AI companies, more or less. So they're growing at 13%, and they don't see a problem from their standpoint. Necessity is the mother of invention. They don't see the necessity yet. Saylor saw the necessity as a mid-sized company that was stagnant, and he felt he didn't have a long-term survival, so he was forced to go look for a solution. They're not in that kind of situation. So the expectation is price needs to get a lot higher to make them move off the dime. Okay, now I want to go inside Metcalfe's law, and I want to ask this question about why are we observing adoption growing as roughly the cube? So the basic thesis, Giovanni's basic thesis is that price is proportional, market cap is proportional to the value of the network, which is the square of the number of users. So if n is the number of users, m here, the exponent is 2, so that's Metcalfe's law. Could be a little less, but it's of that order. And then adoption in the number of users grows with time is some other power law. And this is an observable, and we observe it to be 3 or a little bit higher than 3. I think 3.1, 3.17 or something is what you're observing. Is that right, Giovanni? So if you put the two of those together, you multiply this lambda by the m, then you have lambda times m is 6. 2 times 3 is 6. So the question is, though, why are we observing lambda to be 3? Okay, let's look at the internet. This is a chart I did of the internet and an article that I wrote some months ago. And it followed a power law until it saturated. Overall, the power law was quite steep, 4.6, very high R squared, until saturation in 2020. The second half it slowed, and it was about a 2.8 index. And eventually 2020, you had 5 billion users, so almost everyone. So what we're trying to do here is get at the why. We like to ask why in physics. There's
It
no
turns
why.
out that, for example, some viruses spread with the power law 3.
Right.
Like
so I'm going to give
AIDS, for example.
Right. So I'm going to give you a conjecture. Sorry.
Yeah, that is one of the strongest questions I have. Where this 3 comes from.
Okay, I'm going to give you a conjecture for it, and then I'd like your discussion as to what you think. Okay, so why is lambda 3? And that's capital lambda because Keynote doesn't know how to do small lambda in the title. So adoption, number of users are really could be beneficiaries if it's through an ETF growing as t cubed. Lambda we observe as 3. And my argument is that there are 3 mutually reinforcing factors. There's the lifetime and awareness, and then there are more on-ramps that make it easier to buy. It's like you have a reservoir and you open up the sluices, you've got multiple channels for the water to flow out, or in this case, the capital to flow from fiat into Bitcoin. And then over time, the capital commitment grows. People start with a small allocation, and then they like it, they add more, or even if they don't do anything, it goes up in value and it starts to take over the, more and more of their portfolio, just passively. Okay, so I had this little discussion with GPT-5 and said, look, here's my story. I think it's a 2-stage process where awareness comes first and channels are second. It agreed. It said there's awareness, but it's hard to access. And certainly in the early years, it was difficult for people. And keeping your own wallet and dealing with the security of that. And then when you got around to the mid years of last decade, there was channel expansion through the exchanges. And then when you got later on, you had other ways to invest through mining companies, treasury companies, trusts, and then later ETFs. So that is just an annotation of the fact that you had more channels, as time went on. So the idea is that it's some kind of product of these two, and that collectively that gives you something like the third behavior. So what we're going to do is investigate how those things grew. So my framing is, and GPT was agreeing, adoption goes times awareness times channels with an exponent of 3 or so, and then value goes as adoption to the beta with beta, around 2 or near squared, and that gives you a power law of time to the 6 for the price. So one little note on commitment, if people have a portfolio and they put a few percent into Bitcoin, their fiat assets might grow 7 or 10%. But over time, the portfolio weight of Bitcoin is going to grow as t to the 5.8. So, the Bitcoin on the top over the Bitcoin plus the fiat is going to keep growing at the expense of the fiat. So their commitment is going to grow even passively. Okay, so what we did is regressions on awareness. And that's just based on surveys. So I had to go out and gather some surveys and then do a regression on that. And then early days, it was a power law slope of about 3 for the index. And then late days, it's flattening out and it's more like 2. And the break was about 8 years ago, about halfway through its life. So that's awareness. Then the top 2 are about channels. So the middle one, it has these kind of stair-step looking curves in 3 to 4 different colors. I asked about how quickly did we get growth in top exchanges, top public miners, top ETFs, top corporate treasuries. And so this just shows the growth of those sort of up to the top 10. And then I combined all of those together. And so you form a power law, which is the cumulative number of large-scale channels versus Bitcoin age. And overall, it's a power law fit of about 1.4 for the index. It was actually a little slower early on, and it's steepened a bit as the whole network maybe has become more efficient, has a lot more options for people. I don't know, but it's not that different. It's 1.5. And R squareds are quite good, 0.94. So then the next question is, if you take awareness and the channels and multiply them together, take just the straight product of those two, and then refit, what do you get? And what you get is a power law time to the 4th. And it was about 4.1 in the early years, and it's about 3.6 in the late years. And R squared is extremely high. And of course, institutions start becoming more and more dominant at the midpoint there. So just the product of awareness and available channels and ease of investing gives us kind of emergent t to the 4th power law. Any comments, Giovanni, on that?
It's a very good model. I want to study it myself a little bit deeper. It looks complicated, but probably it is complicated.
It is complicated.
I was hoping for something more fundamental. But, yeah.
Well, it's not proven. It's a conjecture. It's a hypothesis. It seems to have the right rough orders of magnitude implications.
Mm-hmm. We can test it. Yeah, we can test
it. We can find various ways to try and test it and flesh it out. So the number of users is a function of awareness and opportunity. Now, that could be a multiplicative function and you add the exponents, or there could be
Mm-hmm.
some in log n's in there, right? Or
Right.
some additive terms. But this is the simplest possible function, is just to say that the number of users is awareness times opportunity.
Right.
And then adoption, if you think about adoption in terms of number of Bitcoin, not number of users, that's equal to users times commitment.
Right.
So this is kind of a flow diagram that says awareness plus channels lead to adoption, well, it's called an adoption here. It's really the number of users growing is something like the cube or better.
Mm-hmm.
And then commitment's more of a two-way arrow, because really what happens is the price goes up, people's commitment deepens. And they may decide to commit more in absolute numbers of Bitcoin, or they may just ride the passive curve, right? So that's kind of a two-way arrow. But it's probably, in terms of direction or the forcing function, more of the other way. So what I'm saying is that adoption in total Bitcoin is really users times commitment.
This sounds cool.
Yeah. Okay. Well, we'll think about that some more.
Yeah.
I
It's
just want
for
to
sure a
present
step forward relatively to where we are now.
a framework. We're physicists. We like to burden ourselves with the question why. Okay. Now this is back to the Hurst exponent topic. And for people who haven't seen this before, Hurst exponent measures how persistent that price behavior is. One way of showing the persistence is to just look at how the power law index changes over time. And, in the early days, it oscillated and then it smoothed out, and it's been very close to the same value for a decade now. But you have these bubbles that are sort of confounding things. So given all that, how persistent is the behavior? And the Hurst exponent, if it works out to be 0.5, and it's its own kind of power law, but I won't go into the details here, that's a random walk. And if it's a low number, less than 0.5 and close to zero, then it's mean reverting. And stocks are more like that. They tend to give you numbers like 0.2. And if it's above 0.5 and a lot above 0.5, that means trend persistence and strong trend persistence. So I've published this chart in the past. There's a Substack article you can find on it. Just my first name and last name at Substack. But I ran it through Perplexity. I asked Perplexity, what do you think about the Bitcoin Hurst exponent analysis? And it found the article, and it, gave its opinion that the significance greater than 0.9 indicates very strong persistence and highly reliable trend following behavior. And then it goes on the details about that and suggests Bitcoin exhibits an anti-fragile and lending nature, with its survival and growth likelihood increasing with time. So that's kind of our net takeaway of this high value greater than 0.9 across the full life. And somebody, there were 15K views. One person said, recent studies show that Hurst exponent stays around 0.5 on longer time scales. Well, and then they said there's no evidence supporting 0.9. Okay, well, I couldn't let that stand. So I took less than 10 minutes, and I just happened to have a file of monthly prices, and I gave that and a 4-sentence prompt to GPT-5. Part of it was testing because GPT-5 was new. I wanted to see how well I could handle that. And the prompt is simply monthly prices Bitcoin from 1st July 2010 until July 2025. Ages are from 1.5 to 16.5. Convert ages and price to log values, run a quantile median regression, determine the log price residuals, and run a Hurst analysis. It did all that. It did it very quickly. So the whole thing was 5 to 10 minute exercise. And here are the results on the right. Sorry, that's no, I'm going to show you the results on the next page. This is showing, it also then went on to say, the GPT-5, it went on to ask, well, do you also want to look at the core and the bubbles? So we'll show that on the next slide. And then just to, okay, let me set up the problem. The reason why this guy was saying that the exponent stays around 0.5 is he's seen other studies, and other studies always detrend by just looking log differences from one day to the next or one time interval to the next. But if you want to do it right for the long term, you have to detrend with the power law. And I was the first one to do that, and that's why we get a result with 0.9 or higher. So I asked that very question, that framing, to GPT-5 and say, okay, if we're looking for persistence and long-term adoption curve, which detrending method should we use? And it said, use power law detrending on log price and then estimate H from those residuals. If you only care about the short-term horizon predictability of returns, then you can use log differences and you'll get, different H values. So that is the essential nature of why he was responding the way he did. Okay, so what were the results that it provided? That little sort of reddish box, the Hurst value was 1.01 for the monthly data over 15 years of history. And it used a second technique. It's called DFA, detrended fluctuation analysis. It's basically a Hurst style analysis with a different algorithm, and it found even higher value, 1.4.
Yeah, very familiar with DFA.
Yeah, and it did the quantile regression, came up with the usual 5.8 kind of power law, even though the data was pretty sparse. And then the two charts show the actual slope of 1 and 1.4 for the two different methods, where the way that technique works is you change the size of the window and you look at the maximum value and minimum value, and you look at the standard deviation. And you take the ratio of max minus min over the standard deviation, and then you see how that changes as you grow the window. And that changes as a power law with an exponent H, which is the Hurst exponent. So those are the dots that are plotted here, changing the window size, seeing how much this statistical parameter changes, and then taking the slope. You can see it's a really nice behavior, very high R-squareds on those to get that 0.1 and 1.4. And then I think the last thing is the bubble in the core. How did it behave differently? And so we split them. We used a 40-20-40 split. We took the top 40% residuals as the bubble and the bottom 40 as the core. And for the core, we found about 0.8, 0.85 with both techniques. And for the bubbles, they were higher, about 0.9 and 1.4. And it didn't have a lot of data. It's 73 data points is not a lot when you're doing Hurst, because you've got to keep cutting your window size. So the fact that it could do it is already kind of remarkable and came out well.
Yeah.
And then you see the little tweet. Okay, he gave up. All right, now I want to get into the latest log periodic fits. And we get different views depending on what time frames we use. I just ran all these analyses yesterday, and I ran with 2 years of data, 1 year of data, 4 months, and I used 4-hour bars for that, and 1 month with 1-hour bars. So here's the 2-year chart, and the upper chart with the colored bands just shows, the ones with positive residuals and negative residuals are in the transition zone near zero. The orange dashed line is the power law. This is a log linear chart. You don't quite see the curve because it's a short time interval. And there's the price history, and then the dotted line is the fit of the SORNet log periodic parallel model that has waves in it. And that dotted line is the same as the dashed line in the lower chart, the orange dash line, which is the fit. It's got a very high R squared of 0.96. I've got shading for the plus and minus 1 sigma in the prices. And these are log prices. These are natural log prices plotted against linear time. And I've translated what different levels mean in terms of thousands of dollars on the right-hand side. So this shows 3 nice waves and then an expected continuation towards a critical time of February 8th next year. And a
That
price,
is so interesting. So
yeah,
basically, we have an extended cycles, like somebody says, and it goes all the way to February.
okay,
Right?
don't jump to conclusions quite yet.
Okay.
This is evidence for possible extended cycle is the way I would phrase it.
Yeah.
The uncertainty is about 9,000. That's at the current last data point. So that's a width of 18,000 in that band. And the price projection 3 days before, it's very hard to project right up to the critical day, is 163,000 early February. Okay, the next one is 1 year. Daily data. High R squared, 0.945, a bandwidth of 11,000 plus or minus 5,500. The critical day is September 1st, 4 days from now. The price at, I say 4 days from now because I'm in the 28th already in Asia. The price 3 days before the 1st, which is tomorrow, my time, would be 120,000. I don't quite see that happening.
No.
Right? So this one is, shall we say, optimistic. And in fact, the breakdown is covered up by the dollar sign here. As we know, it broke down below 110 and now we're at 111. And but 109K is that level of 11.6 of log price. That's roughly where we are. And so this one is a little questionable. Really, the way I would interpret this is saying, because TC is kind of when it's almost the last date when you'd expect the crash or breakdown to happen.
Right.
It can happen before that. So this is starting to argue for it having happened before that.
Mm-hmm.
Now, if we look at the 4 months, it actually gets murkier. If we look at the 4-month, 4-hour data, it says, well, I think it's going to continue, and it projects it out to October 3rd, but this R squared is not as good. It's 0.83.
Right.
And it projects 126,000 in the beginning of October, which, seems certainly achievable. So we've got a very positive one, a sort of negative one. This one's optimistic, reasonably. But the other thing you notice here is that we broke below the previous recent low. So that's concerning. Okay, now the 1 hour. For the 1 hour bars, 1 month, it says we already peaked and we're going down. So it's now calculating an anti-bubble. And it's projecting downward until roughly the same time frame as the last one, which is, in this case, October 10th is a critical day. The R squared is lower here, so there's less confidence. It's 0.7. And the price down there is not so bad, actually. It's 107,000. So it's not much lower from where we are.
Mm-hmm.
So we've kind of got 2 very broad scenarios. It looks like we've got a break, but it also looks like we could recover and then go into next year with a much higher objective. And I've summarized. Yeah.
One of the methods that people use to know which one of these many models are the ones that you should choose is that you're going to see some kind of convergence at different scales.
Right.
And when they converge, so basically they say the same thing, then it is much more reliable analysis. And one of the things that it seems quite obvious right now that they don't really agree. So
Right.
there is not much of a convergence. So I think what I like is that, in particular, if you go to the previous slide, I like in particular, the first graph, right? But to me, at least from a qualitative point of view, it says, yeah, one of these two, the second one, and then the next one basically says, look, we are observing these oscillations. The oscillations are there. They look
Right.
exactly like they should be, like faster and faster oscillations. Something is going on here, right? We are expecting some kind of a critical event. It's just that I don't know if we need one more of these oscillations to start to converge to some kind of coherent picture, but somehow it's not yet finding, some agreement between the different scales. So it means that
I
think it means that it needs more data.
Yeah, well, yeah, and I've set the pipeline up so I can easily run this every day, and I think we're going to see some resolution with the 4 month, between the 4 month and the 1 month. The 4 month may start to agree with the 1 month, for example.
Yeah.
Unless we
Can you
recover
try to
here,
do 2 years going in the other direction, make it a little bit longer?
I did in the past. I did 2.5 years. It wasn't that different from the 2 year.
Okay, from 1 year you meant?
No, you said 2.5, right? Or 3?
Say two or 3.
Yeah. I did 2 years and 8 months, and it was not that different from the 2 year chart.
Yeah. Okay.
And I'm using Kraken, and it limits you to 720 data points. So that's the 2 year limit, unless I were to go to weekly.
I can give you data. I can give you everything.
This one, actually, I like this one. It's really easy to use, the API. Okay. So just summarizing in that table, for the 4 different models, you show the critical dates. And, 3 of them are in the September to early October timeframe, right? But the best R squared are the 1 year and the 2 year models that don't agree fully, but the 1 year says, okay, you could continue a little bit higher. Maybe the data is off, and then you might have some break, but then you have time to recover to go into next year. Now, I would say all is not lost because of seasonality. The worst month for the stock market is September. And it's also true that for Bitcoin, the worst month is September. And August is the second worst month. So it's not surprising from a seasonality that we've been flat to down. And we can expect more of that maybe in September. But then seasonality says you can have very strong recovery in October and November and into the end of the year. So I think all is not lost for that, projection into February of next year. Another mildly relevant thing is NVIDIA's chart. And it doesn't have as many oscillations showing here. I think I only did a 1 year on this. But it's showing continuation into March of next year. Maybe next week I'll show the master charts again. The master chart was going into February, March, the last time I did it as well. Okay. Maybe we don't have bubbles. Maybe we have waves. Maybe we don't need bubbles. We have the clarity of the power law. Bubbles and exponentials are about froth and decay and instability. And with that, I will end the slides.
Good. Thank you so much. Yeah, I'm curious. Send me the slide or some of your analysis about the power tree, because I would like to help you investigating that.
Yeah.
want to understand it better. Because I think that is one of the biggest theoretical open questions, where the tree comes from. We know where
I,
the two comes from, right?
right.
Metcalf,
Right.
some modified Metcalf, and even gave a theoretical proof of why the market will respond in that way. And I'm
Mm-hmm.
writing an article that we should write together. But then the tree will be the other interesting piece to explore.
Mm-hmm.
Anyway, so I'm going to share my screen. I have a usual problem, but I don't know how to make it bigger. One of these days, I need to figure out this. How do you do this? Okay, maybe this helps. So let me reduce this. Let me reduce it completely like this. Is this slightly better?
Yes.
Okay. Maybe I can. This. Not showing this ribbon. This doesn't go full screen, right? Because I
Yeah.
just went.
That's good. That's good.
That did it. Okay. All right, so the first thing I want to show, it's an update on the power law. This is how it looks like. Um, and we have to say that the power law looks better than ever. It's actually recently we are hugging the power law. We are following the power law to a dot. It is an anomaly because usually we are kind of like here, very close to the peak, because basically we have left something like 3 or 4 months, right? If we reach a peak at the end of the year, that is what usually happens in all the other cycles. So we should be here. We should be all the way there. Now, even if you account for this decay of the peaks, that is kind of an exponential decay, we should be, right now we should be like 150, 140, something like that, and we are not. So I don't see it necessarily as a problem. Something different from what we did before. We have to live with it. I don't mind if we continue to follow the power law and we oscillate, right? We'll have to see how big these oscillations are. We are not going to see anymore these big, huge peaks like before. Is this a bad thing, a good thing? It's arguable. I think there were bad and good things about bubbles. The bubbles maybe excited some people when we saw some of things like this. People started to go crazy. The press started to talk about Bitcoin. Right now, if you look at retailers, like you're saying, they are not very active. If you're looking at Google searches, for example, I demonstrated there is a power law between Google searches and the price of Bitcoin. Right now, it's actually a little bit below from where it should be, given where we are, even in terms of considering that we are supposed to be in a bubble. Um, so basically, that maybe is missing. That is the trade-off from of having all these institutions. Maybe there is still interest maybe through the ETFs, right? Because the people that buy the ETF works like a single entity, but really it's made by a lot of small investors too. So it's a different regime. The interesting thing is that we are still following the power law. It is basically the main tenet of a theory. The theory says doesn't matter how big these actors are going to be because it's a scale invariant phenomena. It doesn't matter. The process will still look scale invariant, even if you have larger and larger participants. So far, it's a theory. It's a proposal, right? We have to test it continuously to see if it's valid. So far, it's valid. So it's not invalidated. It's not falsified. Um, anyway, so now I don't show here how I went in this direction. This is something that I explored before, but uh, periodically I revisit this topic. But there was somebody. Um, it's okay if I don't show the precise post. I don't want to humiliate the person. It's good when people want to learn, investigate. One thing I invite everybody though, if you want to learn about this topic, one, ask questions if you don't know exactly what you're talking about, and two, maybe research it a little bit better because from what I understood, this person was basically dismissing the power law, saying, I don't know which power law you're talking about, because if I look at the returns, so he was talking about the returns. If returns means, right, basically the change in basically how much you're making by holding Bitcoin. You can measure it over 1 year, over 1 week. You can measure it daily. The returns distribution. So what is meant for distribution? Distribution is when you want to know if you have a range of values, right, for something like these returns. Some of these returns, it depends how you express them. If you express them as a ratio, I like to express them as a ratio, like this P2 over P1. So the value of the price at a particular point. So let's say today versus the price 1 year ago, you take the ratio, that ratio, it's your return. You can take the difference, that is also return. I like ratio like this. And that value can be above 1, it means that you went up, you made a gain. You can be below 1, you had a loss, right? And these returns in general can be above 1 or below 1, right? And then we'll have a distribution. Distribution means if I make a graph where the x-axis is the different value, and usually how we do it, it's in beans, because basically we say, okay, let me choose 100 beans. And that is exactly what it means. It's almost like a container. You're putting there, imagine I'm dropping there all the values that are between a certain range, right? You can look at the minimum value, the maximum value of these values that you're looking at, like in this case, returns. And then you're saying, if you divide by 100, right, you will have whatever change, right, from that first being from the minimum value to 100 of entire range, right? So you're looking at that being and say, how many you count? You say, how many of these returns were in that range, right? And you count. So on the y-axis, you draw the count. How many of these counts you have in that range, right? So you're going to create what is called an histogram. So you're going to create an histogram. It looks like bars, a bunch of bars, and the height of the bar represents how many values you have in that bins. Now, many of these phenomena have some kind of what is called Gaussian distribution, the famous bell curve. So it looks like kind of low as you go away from the peak, low values here, and then it grows like this, right? And it's relatively symmetric. The peak represents the average, and so on. And so this guy was saying, well, the return. So what you could do, you could look at the absolute returns, right? So, for example, you take if a value is above 1, you take 1 minus 1, and if it is below 1, you say 1 minus that. Sorry, yeah. So it is above 1, you take the return, you subtract 1. If it is below, you take 1 and you subtract the return, right? This case basically look at how far away you are from 1, right? And then they will be all, it doesn't matter if they are below or above 1, they will all be similar. And then you can look at the distribution of that. And this is what basically was looking at. And he was saying, well, there is no power law distribution there, but we never claim that. That is not the power law distribution that we are describing, the power law that we are describing. We are describing a power law of growth. That is a completely different concept. Now, there is some relationship in the sense that this curve still look like if it is a power law distribution, and there is such a thing called a power law distribution. Like, for example, the distribution that Stephen was talking about, and by the way, it's called Pareto and not Pareto because it's an Italian name. It's Pareto, a small correction, Stephen. So the Pareto distribution that Stephen was talking about, it's a distribution, in that case, of wealth, right? And that in this case, right, was wealth of the treasury companies. That is a power law, and it looks like a straight line in a log-log graph. So there are some similarity in concept and some transfer of knowledge, but it's not the same thing. So we are talking about a function, right? It's a function, not a distribution, a function in time of a price. And it's not that there are no power laws like that. There are a lot of power laws like that. For example, there is this famous article that I mention all the time that looks at how structures like teeth, shells, horns, thorns grow in time, and they grow like power law. There is a beautiful graph in this article that I mention all the time. I don't have it here in the slides, but I can post it again on X. It shows the radius, of a trunk of an elephant for the male and for the female in average, and on the y-axis the radius, on the x-axis time, and it's a beautiful straight line in a log graph. So it's not that there are no such things. There are. So this is what the power law that we are describing. So this guy was confused about this. I want to make sure that people understand the difference between distributions and a function like this, okay? And if you have questions, I can explain it. I can tell you the difference, but that is the main idea. Now, this led me to the question. So how a distribution of returns will look like? It's not that I didn't do it. I'm running out of topics. I mean, hopefully we'll never run out, but believe me, I explore so many things of Bitcoin. So of course I look at this. We did with Steven, both of us, we tried to show how a distribution looks like. It's actually really by model, there are two peaks, etc. But honestly, you cannot really say there is one distribution because it's something that changes over time. If you look at the distribution a few years ago, it will look different from now, it will look different from the future. And the reason why is because the returns are a function of time. How do we show this? Well, if you have this equation, right, we say it's a power law. This is what a power law means, that you have a price as a function of time to some kind of a power, right? So if you imagine I have two times, right, two different prices, P2 at time T2. This will be P2 A T2 to the n, and P1 will be A, same constant, T1 to the n. If you take the ratio, that is what the return is, A cancels, right? And then this, I can, bring both of them under the same parentheses because I'm raising to the same power, and so I'm going to have T2 over T1. Again, this time is sometime in the future, it could be 10 days from now, a month, 1 year, whatever. And this is some value where you measure the change from, right? Now, if you looking at daily returns, where basically T2 is only 1 day above, so it's going to be T1 plus 1. I can drop this T1 and T2 and so on, and I can write it in this way. I can say, and in particular, if I take the log returns, things actually became simpler because if you remember from high school, right, I bring down n when I take the log or something like this. I bring down n, and then I have log of T2 over T1. But because T2 is basically T1 plus 1, I can simplify like this. So this is how the daily returns looks like n, the log of the returns look like this. A constant times the log of t plus 1 over t. Okay, so this is a function of time. That means the returns are not the same. In fact, we know that they should go down. We have diminishing returns. Why they go down? Because basically, right, these, as time passes, the difference between t plus 1 and t becomes smaller and smaller. So imagine I have, right now it's not, right now with t is 6,000, right? When it's 10,000, 10,000 plus 1 over 10,000 is a number that is much closer to 1 than 6,000 plus 1 over 6,000. As this t becomes bigger, basically I can ignore 1. So this number tends to 1. So whatever they were, like 10 times returns at the beginning of the history of Bitcoin, this number tends to 1. It will take a long time. It starts to slow down, but eventually, it never goes to 1, but it tends to 1. You see, this is why it's diminishing. It shows that it's diminishing return. Now, do we have any evidence that Bitcoin follows this behavior? Well, yes. if I plot the returns, these are the returns, in fact, these are the log returns, the middle line is the theoretical curve, that one that I just calculated from theory, okay? And you can see it kind of in the middle. And this doesn't, it looks very impressive because, okay, it's some kind of line in the middle, but if I zoom in, now you can see actually, see these were much higher here, they start to go down, kind of flatten, they start to tend towards 1. In fact, log, this will be 0 because that represents 1. The log of 1 is 0. So it tends to this 0 value. This is where we are right now. And you can see this theoretical curve just by inspection, without doing any calculation, it is kind of in the middle, and does it represent some kind of an average? Yes, because one of the things we can do to go even deeper, we can try to eliminate this time component by dividing by it. So we can take the log returns, we divide by this time component, and then we get a constant. And that is cool because basically we found what is called in physics an invariant, right? When I say scale invariant, that means, okay, the scale is invariant. But this is another type of invariance that basically say it's a way of making the returns invariant in time. So they don't change in time. And it's a big deal because in physics, we are both interested in what changes and what stays the same. If you know what stays the same, you can understand better what changes and vice versa. So there are many quantities that are invariant, like energy, momentum, etc. And that they are fundamental in physics. So this is a really cool way of saying, look, there is another important invariant in Bitcoin. So we are not even talking about fitting some kind of a curve to a price. We are saying, look at this, if it is this behavior, if it is this behavior, if it really the price is some kind of a function of time that is a power law, that I'm expecting to find some kind of invariant in time of the returns when I divide by this quantity. And so the distribution then doesn't change. It should be always the same because you're already taking out the time factor, and should be distributed around n, that is the slope of the power law. Do we see that? Yes, this is the result. That is really cool. I already did it in the past, but now I'm understanding it as a way of normalize by time or making it invariant the returns. And it's a big deal because in finance, returns is one of the best way to characterize some kind of financial process. If you want to understand really how something behaves financial, in the market, you look at the returns or the log returns. And here we really demonstrated that the power law is something really fundamental for Bitcoin, because look how regular and beautiful it looks like. We are going deeper, right? If you understand a little bit of stat, etc., doing a fit has a lot of possible pitfalls. Here we are trying to look at something much deeper because we are taking changes. And so if it was a spurious type of process, when you take the changes, usually these spurious effects disappear. But we are here, actually, they are present. That means it's a real phenomenon. The power law is a real phenomenon. And you can see here, if I calculate the average distribution of these normalized returns, is really the slope of the power law, but you can think it almost like a normalized type of return. We get 5.83, that is very close to the observed power law. And you can do it using different type of distribution. So here is the Gaussian, the bell curve. It doesn't really fit that well. Then you can use Laplace. It's kind of okay distribution, but the best type of fit seems to be the Lorentzian distribution. This Y is kind of like similar to sigma, that tells you how wide the distribution is. Not exactly, but kind of similar concept. And mu is the power law, basically. So it's a really cool graph I think there is a lot of information there. You can see there is a little bit of a bump here in the positive value that probably is due. I need to verify. I can color code the time when we add the bubbles and see where the values are. But I think that is mostly due to the bubbles. We have an excess of positive values here. I'm pretty sure that is the case. But we can go deeper and check. Now here are some stats basically showing that we get really, really good fits. The R squares are in the 0.945, something like that. Then what I did, I plotted this value over time for the last 3.5 years. And you see it's oscillating. This is basically before the bubble. I can make graph like this. You can see during the bubble, usually it's higher. I don't have it in this graph, but I already shown. I will post it on X. But there are variation, there are oscillations, and right now the value is something close to 16 or something like that. So it's a little bit higher than 6, but because of these large changes here, some of the values are 600 or minus 600, etc. So 16 is pretty close to the average. So this red curve represents some kind of moving average of it, of these values. Anyway, so this is what they did. Do you have any questions, Stephen? I cannot hear you anymore. Hopefully it's not my headphone.
No, it likes to turn down my volume. Okay, how's that? It looks good.
Okay.
Looks good.
Perfect.
Yeah.
Perfect. Yeah, I really like this idea of a normalized distribution, right? Because it talks about some kind of fundamental property of the coin, right? That is invariant in time. So it's something that doesn't change, and that is always powerful when you find that in physics. Okay. All right, we can try to see if there are any questions. Somebody from Thailand, from your same country. And then there is John Smith. He makes a lot of interesting comment. But basically, I can try to respond to these. Wait, I think it's first comment is here. Okay, but it's kind of a question. So it's a possible interpretation, right? With when you see, so there are many situations that are called critical phenomena, where you see a change of phase, right? So, for example, when water transforms into ice, one of the things that he observed, in this case, you have to be careful because, yes, in this case, we are talking about the distribution. So, on one end, I say we are talking about the function, and now I'm going to talk a distribution. Here, this is where you will say there is some kind of analogy, but we have also to be careful, right? So maybe the example of the thorns and horns, etc., that is actually a better example. But in general, yes, there are some phenomena where you have these changes of phase, and you observe some properties. In this case, for example, what you can observe, if you're looking at the size of the clusters of ice that are formed when you reach the critical temperature. This is another term that, similar to the critical time that we were describing before. Very, very similar idea. In this case, it's a critical temperature. So as you come close to that critical temperature where water goes from, liquid to ice, you see all these little clusters of ice. And if you zoom in, you will see things that go all the way through few molecules to size of ice, size of the clusters, pieces of chunk of ice that you will see with your naked eye. And if you look, if you make a graph of how many chunks there are with a particular size range, like this distribution graph, like this one that I'm showing in the screen, you will see a power law. If you plot it, so it will be on the y-axis is the count, and on the x-axis is the size of a chunk. You will see a power law. And that is, people study these in so many different situations. This is just an example. And it's one of these things that we call universal in physics, because you see over and over and over and over the same type of we call it scaling value. It means there are the same type, there are chunks of all sizes, and they are organized in this way where it's the scale of the the scale of these chunks is proportional to the number of the chunks. To the scale, the scale of a number of the chunks. So the scale of these two things are proportional to each other. This is why we have a straight line. And there are theoretical reasons people analyze it. There are big, huge book like that explaining why this happens, why the system organizes itself in this way. But yeah, it's a signature of criticality. That means you are on the edge between order and disorder, between order and chaos. It's really fascinating. So in theory, you could make this analogy and say, because Bitcoin follows these, it's a phenomenon that is in between order and chaos, right? So it's a very fascinating idea to think about. The other point of view is looking at how cities grow, how teeth grows, etc. And it turns out it's a way of optimizing resources. This is why nature follows that. This is why, when we say that Bitcoin follows a power law, it's a big deal. It's not like any other function. It's like, it follows this thing. It's a very special case. It's a very important function. Maybe physicists are a little bit enamored with these phenomena, but because they are important. And so it's an optimization process. And there are many reasons why it optimizes. Basically gives one way of thinking about these, these diminishing returns that we mentioned is not a bug, it's a feature. As the system becomes grow, so it allows the system to grow very fast, right? If you think about Bitcoin, it allowed Bitcoin to go 10 pair initially. It could grow crazy, because otherwise, if it didn't grow crazy like that, probably will have died. It attracted enough resources, enough interest, where a lot of people join in very quickly. It brought the resources, the coding, the investment, and then it kind of cooled down because it could not sustain that 10 pair growth that we had in the beginning. We still had a very powerful growth, but it needed to slow down because it needed time for infrastructure to be developed, to be accepted by the general public, etc. And so this is what allows the system to both grow, but also adapt to larger and larger investors. This is why larger investors could not come in when we were growing 10 pair. They will not be interested because it brings too many risks. We are interested in coming now because it's still great gains, but we are in the realm, in the order of magnitude of what we are used, like, 20, 30, 40% a year versus 10 pair. So you see, it's really the beauty of a power law is that it gives you a framework to understand almost everything that it happens with the coin. Once you start to learn this language of a power law and what it means, this is why I recommend everybody to read the book Scale, because it discusses all these topics. You will be able to understand a lot of things about Bitcoin. So yeah, you're right. And I like all your following comments. And I think most of the things you're saying, they seem to be correct. But you have to be careful about these analogies, but they fit. They are proper analogies. And then we have this question. Will you like to answer, Stephen?
Sure. Timescale. Well, we had a big downdraft in 2022. Price bottomed at the end of 2022 and started rising relatively steadily, with various pullbacks from 16,000 at the beginning of 2023. So it increased by a factor 7. So we've had a long uptrend. And so it would be natural to fit that entire uptrend. And I've done that up to the 3-year time scale. But really, this technique that Sornet developed, this log periodic parallel model, is intended to model bubbles and crashes. So things that are accelerating upwards where the waves are getting closer and closer. So we picked the time scales really to reflect, what the chart looks like grossly. How have we seen these waves? Then we try to model, are they getting closer and closer? That's almost the first thing you do. You expect that the ratio of the time between wave 1 and wave 2, and then the shortened time between wave 2 and 3, you take those two durations, that gives you a parameter they normally called lambda, and it's how much, it's kind of a shortening parameter. So in other words, if wave 1 and wave 2 were 3 months apart, and if lambda were, say, 0.67, then between 2 and 3, you'd expect it to be 2 months, and then between 3 and 4, you'd expect it to be 2/3 of 2 months, a little over a month. And you typically see parameters of lambda around like 0.5, 0.7, numbers like that. And that's related to this omega parameter, which is just expressed in terms of the angular velocity, essentially, or the angular frequency that's in the expression. The expression has a kind of longer term parallel trend, and then it has these oscillations getting closer and closer together. And when you look at that omega, it tells you how quickly they're getting closer together, and sort of translates into roughly how many you're going to have until you reach the critical zone. So you're trying to capture, the way this wave motion behaves. So you've got to go back to when you saw the thing moving up. That's not going to be the whole answer, because as you get closer and closer to the critical time, which you seem to be doing, and the waves are coming faster and faster, then you need to refine your resolution, right? So previously I've been doing daily analyses, but now because we're getting closer to these possible critical points in September 1st, early October, then I'm going to 4-hour and 1-hour bars. And the smaller the bars, you don't want to go all the way back for 3 years, because you're not really looking at longer or intermediate term behavior. You're looking at how things are speeding up in the last several waves. That's what you're fitting to. So it's a bit of an art. And as you can see, we're getting results that don't fully agree with each other. And so then you get into kind of interpretation situation. And of course, always the need to monitor and add more data as you go along and get closer to the critical time.
There is if you want to know more about, let me post it here. It's called Why Market Crash. Is that the name of the book?
This is the book.
Yeah.
Why Stock Markets Crash. It goes through all of this. In fact, if you want to do very long-term stuff, there's a 8-parameter model. It adds one more parameter. I've presented that in other shows. If you want to look at stock market over decades, you can even try to look at Bitcoin. It doesn't really work, because this is appropriate for things that have kind of exponential behavior, rise and falls, and Bitcoin is not that, right? So that's why you want to use it for the bubbles. You don't want to try and it does not work. And people should not get confused between log periodic power law and the power law that we normally talk about, which is the very long-term behavior. This is something that has waves coming faster and faster, and that's what log periodic means. It means that the periodicity is in log time, not linear time.
Yeah, locally it works with bubbles, and in fact even short like some of these local events, they can also be described by the log periodic power law. Like right now, what Stephen is doing, there are not really these huge bubbles that we saw before, but we still see nice fitting of this oscillatory behavior. But um, maybe there is a way of modifying, the work and making it work overall, right? Because it will be really cool to adopt this model and add the bubbles, right, as log periodic power laws, and still fitting it in overall power law growth. I don't know. We will have to look at how to do that if it is possible, but I'm not sure. Um, but yeah, it's really cool because we like this guy. He's a physicist and he's applying. He has the same idea, right? It's like a point of reference for us because he's applying cool physics concept to finance. It's not the first one. Maldebrot did the same, but these are some of, and actually he was a fan of power law. There is an interview. Have you seen this interview where Mandelbrot talks about it's a long interview made of different segments, and there is a one section where they introduce the concept of power laws. Have you ever seen that series, Stephen?
I only little segments, clips. Yeah.
Yeah, maybe I can send you a link.
Yeah.
But anyway, I think we cover most of your questions, unless there are others that are missing. This is it. Okay. All right. Let us know if you have questions about Stephen and us, and me, and are on X. So you can always ask questions about what we discuss. I really suggest you to watch these episodes when you have time. I know it's late at night for a lot of, for example, US people. You can find them on YouTube. All right. Thank you so much to spend the evening with us or the morning. Sorry for that. And we will see you